So, in the last video segment, we saw that unregulated monopoly has two results. One is that it generates, or can generate, economic profit. And let me go ahead and say a few more words about that. One is, you don't always run a profit just because you're a monopoly. If there's not enough demand for your product, then you're going to go ahead and make a loss. So let's suppose you're again this monopolist, and I won't draw the marginal cost curve. If there's your average total cost curve, and the demand for your product is just low, well then there's just no price that you're going to be able to charge on this demand curve that's going to allow you to cover your costs. So not every single monopoly out there is in fact a profit generating machine. The other thing to say here is, let me re-emphasize this, they can generate economic profit. This relies on some kind of barrier to entry or some other reason why other people aren't going to come along and compete away your monopoly profits. So sustainable monopoly profits rely on barriers to entry. So that won't always be the case in the long run. You might think that you have a secure monopoly, but of course other people are going to innovate and try and come up with substitutes so that they can steal away some of those customers that you're charging such high prices to. So that's one thing to think about there. The other thing to think about, to re-emphasize from the last one, is that unregulated monopoly generates dead weight loss. So, monopolies are pretty unpopular, at least except for the monopolists themselves. And, a lot of times people come to the fact that monopolies charge high prices. And that's true. So a high price, of course, means we're going to have low consumer surplus. But economists object to monopolies beyond that, because ordinarily when we have a competitive market, it's true that a high price means low consumer surplus, but it also means high producer surplus. And if that high price is the market equilibrium, we know that the high price maximizes the sum of consumer and producer surplus. So it's not just the high price and the low consumer surplus that economists object to so much. It's the fact that it's a wastefully high price. It's such a high price that it's decreasing the efficiency of the overall economy out there. So this sort of comes and gets us to the topic of what should we do about this? How should we regulate a monopoly? And one thing you might look at is, well, if we have this issue of the monopolist charging this really high price because they're looking for the intersection of marginal cost and marginal revenue, and they're charging this price up here. So there's their monopoly price, and there's their monopoly quantity. We might go, well, let's have a price control. Let's force the price lower. And if we force the price lower, as the monopoly tries to raise the price, it's not going to be able to do so. So let's go ahead and say that here is our price with a price ceiling, price sub C. Then what happens is the monopolist chooses this price quantity combination right here, and this particular monopolist is still making a tiny bit of economic profit, but not at the same level as they were before. So when we have a monopoly, a price ceiling can increase efficiency. And so if we went back and looked at the examples from the treatment of price ceilings and price floors, those were actually only really relevant to competitive markets. When we have monopoly markets, all bets are off as far as the effects of a price ceiling. Notice it's true, though, still, that a really aggressive price ceiling, say here, can hurt consumers. Because if we have a really aggressive price ceiling like that, then the best the monopolists can do for themselves is pick this price quantity combination right here, and they're not able to cover their costs. And if they're not able to cover their costs, they're going to go out of business, and that's definitely not good for consumers. They might get higher consumer surplus in the short run, but then the business is totally not there at all in the long run. So, notice that if we have an economy of scale monopoly like this, a natural monopoly, this pattern I've drawn here where we have low fixed marginal costs and the average total cost curve is always downward sloping, that's going to be pretty typical for a natural monopoly. The efficient price, again, is, or the efficient output level, is to produce this level of output right here so that we're producing all the units where someone's willingness to pay is above the marginal cost. But notice, that's going to mean that the monopolist is going to lose money, because if they're just barely covering their marginal costs, and that's the efficient price they should be charging, they won't be able to recoup their fixed costs. So, we're going to have this dilemma. Would we rather shoot for this intersection here, where we're trying to match the economists, the monopolists' average cost, or would we rather shoot for this one right here, where we're trying to just let them cover their marginal cost? And it would be really tempting to do this one in the short run, but in the long run we're going to need to have them cover their average costs. Or we could say, charge the marginal cost, and yes, you're going to make losses, but we're going to subsidize you. We'll give you some money to cover your fixed costs. So that gets us to one proposal out there, and sort of two comparative ways to regulate the monopoly. One is, let them charge price equals average total cost, and then the other one is, let them charge price equals marginal cost, then subsidize. So these are both different ways of regulating, and sort of when we get into microeconomics, we're often going to find, as we did with externalities, okay, we have this market failure, and we have a couple of proposed solutions for it. You know, we might have tradable permits, we might have Pigovian taxes, we might have direct controls. What are we going to go ahead and do about that? And there are going to be advantages and disadvantages of each of these approaches. This is often called, letting people charge price equals average total cost, is often called the reasonable rate of return pricing. So we're letting them charge a price so that not only do they cover their marginal cost of production, but they're also able to recoup their fixed costs. And not only are they able to recoup their fixed costs, but we're economists, and we know that part of the costs are these opportunity costs of capital. So we're going to let them earn a reasonable rate of return on their capital investments. The tricky thing here is that the higher my costs are, the more I'm allowed to charge. And essentially, if I'm allowed to charge prices that always allow me to earn, say, a 6 or 8% rate of return on my invested capital, then I keep on investing more capital, and that means I get to raise prices. So that's not obviously a really good solution there from the point of view of the regulator. Again, might be good for the monopoly, but not from the point of view of the regulator and society as a whole. So what about this issue here? If we let them charge price equals marginal cost and then subsidize them, well, it's essentially the same basic problem. They know that if they let costs get out of control, they'll be allowed to raise prices, And they know that if they're inefficient and make losses, the government will hand them money. And so that is not really a great incentive for efficiency. You're going to end up with these organizations that basically don't have any incentive to innovate or be efficient or control their costs in any manner. So those are not such great policies either. A third policy is basically set a slow moving price control. So the idea here would be something like the following. We're going to set initially the price equals average total cost, we think. Then if the firm innovates, and if they're able to reduce their costs, and they are therefore able to make profits, we let them keep that, at least for a while. Maybe we sort of go, well, the price equals what your average total costs have been over the previous 5 years. So in that case, if you're able to reduce costs, you get to make extra profit on those reduced costs for 5 years, and then eventually they become part of the rate structure that you're allowed to charge your customers. And this is the way a lot of utility regulation, in fact, now works. And you have things like the Public Utilities Regulatory Committee that engage in this kind of regulation and decide what the price control should be for organizations like PG&E or something like that out there. Okay. There is another thing that we could do. We could go, wow, you know, that is just all going to get really, really complicated. And what's going to happen, of course, is that the monopolist is going to try and pay off the regulators and corrupt them and so on and so forth. And there's definitely that danger. So we could actually just go, well, let's have public ownership. We could just have a publicly owned utility. And in some cities and towns, the garbage collectors, say for instance, are publicly owned. They're public employees, and in other places they're not. Or some cities and towns have their own electrical generating facilities and so on and so forth. So the issue here is often that the managers and workers now become very politically active. And they lobby their politicians to have higher wages, say for instance, or let them raise prices or otherwise do things. And so we've essentially rechanneled the decision-making process from an economic one to a political one. Also, so sometimes it happens that the sort of employees and so on and so forth turn to try and get favors from the politicians. It also sometimes happens that these publicly owned assets become ways for politicians to give out what's called patronage. So it might be that they give the job as the manager to their political supporters as a reward for their political support, or, you know, they promise these workers higher wages if they vote for them, or that sort of thing out there. So essentially the public ownership issue is not going to solve the problem of corruption. In fact, it may actually be worse than a more explicitly adversarial system where, yes, there's a privately regulated company and it's sort of in a power struggle with its regulator, but at least we sort of know who's who and can keep track of both of them. And generally, economists are not super fond of public ownership because of all of this, instead favoring regulated monopoly. Not completely unregulated, not completely publicly owned, but that sort of middle ground.